A warm welcome to you, my dear children. A warm welcome again with a new lesson. New lesson, and this is the last unit of your syllabus, of your grade 10 syllabus, grade 10 textbook. Last lesson. Unit 12. Unit 12. Correction of accounting errors. Errors. Correction of accounting errors. Yeah? Let's see. Well, when we say errors, children, errors, there are so many types of errors. Yeah, there are so many errors, so many types of errors. Yeah, we have our errors in our day-to-day lives, errors that occurs from our hands. We say sorry, I did this, it's a mistake. Some people even don't say sorry. They're not even sorry that day after they have committed such an error or such a mistake. Yeah, they are not courteous enough to say sorry even. So what errors have you done? What errors have you done which have made an impact, a damage on you? Errors. What errors? Well, we are not here to talk about your errors and my errors. We are not here to talk about those errors, children. No. We are here to talk about errors of accounting. Accounting errors. Let's go. To find out what things that we have to cover in this chapter, let's take a simple breakdown of the subtopics, right? Following facts are discussed in this chapter. What facts? 12.1. The need to correct accounting errors. We need to correct accounting errors. No doubt about that. If something has happened, error, mistake, wrong thing, we need to correct them. Correct. We can't keep errors in our accounting records. No, sir, no. No accounting errors can be, tolerated. We need to correct them. So the need to correct accounting errors. Next we have occasions when accounting errors occur. Where do these errors occur? Identifying these errors. Important. Very important. Identifying these errors. Where do these errors occur? Next, third one, we have identification of accounting errors. Identifying, just like I said before, identify these errors. Where, in what, how this error has occurred. Or where, in what, how the error has happened. In prime entry books or in ledger accounts. There are so many ledger accounts in our accounting books, accounting records. There are so many ledger accounts. We call them T accounts sometimes, casually. T accounts. Are there errors in the T accounts? Or are there errors in the prime entry books, cash book, purchases book, sales book? General journal. Where have the errors occurred? How have they occurred? Identification of accounting errors. Errors that do not affect the agreement of trial balance. That is the fourth subtopic, fourth one, right? Errors that do not affect the agreement of trial balance. What does that mean? So the trial balance should be, agreed. The trial balance should agree. What is the meaning of trial balance? Agreeing the trial balance agreeing. The trial balance goes somewhere and talks to someone in the business and agrees and signs an agreement. No, children. It simply means the trial balance should balance. Trial balance should balance. The trial balance normally should balance. The debit total should be equal to the credit total. The debit column total should be equal to the credit column total of the credit column. Okay, so the trial balance is balanced. Okay, when accounting errors are there, when accounting errors have occurred, this trial balance agreement is disturbed. Simply saying, the trial balance does not balance. So those are errors which affect the agreement of the trial balance, or which affect the trial balance. So the trial balance does not balance because these errors are there in our accounting records. These errors are there. Children, students, get this to your heads. There are errors. There are some other sort of errors, some other type of errors which are not affecting the trial balance. Even these errors, when they occur, when they have occurred, even when these errors are there in our accounting books, in our ledger accounts, even though they have occurred, they do not affect the agreement of the trial balance. That means the trial balance balances nicely. The trial balance debit total becomes equal to the trial balance debit total is equal to the trial balance credit total. So the trial balance agreement is not disturbed. The trial balance nicely balances. So we think that, oh, trial balance balanced. That is just superb, brilliant. All our accounting records must be correct. All the prime books are nicely, properly done. All the ledger accounts are correctly, accurately recorded. Double entries are perfect. Balancing, all the balancing of ledger accounts is also number one. No errors, no nothing, no mistakes. Because the trial balance balanced. No, it's balanced. The trial balance balanced. Hey, the trial balance balanced. Sir, the trial balance balanced. Even though it balanced, there can be errors. Those are these errors. Alright? Remember, some things that children always, get wrong. They get this wrong. When I ask my students, hey, Shehan, do you think the trial balance, when the trial balance has balanced, do you think all your accounting records, all your ledger accounts, all your books, prime books and everything is perfect because the trial balance balanced? What do you think if the trial balance actually balanced? Most of the children say, "Sir, oh yeah, of course. If the trial balance balanced, no problem, right? No problem, right? That is the big thing. No? Balancing the trial balance. When it is balanced, that means all the debit and credit side, everything is perfect." No! No, that's not the case. Okay. Even when the trial balance has balanced, there still there can be errors. Finally, we have accounting errors that affect the agreement of the trial balance. There are other errors most of the time which affect the agreement of the trial balance. When these errors are there in our accounts, we have done mistakes, errors, and the trial balance do not balance. Then we know, we notice who the trial balance has not balanced, right? There must be errors. No doubt about that. Likewise, then we are certain that errors are there. Oh yeah, these are the nature of accounting errors. There are errors which can't be traced. There are errors which can be traced. We have to correct all of them. Let's go, shall we? Going forth, the need to correct accounting errors. The need to correct accounting errors. Why do we need to correct them? Yeah? Why do we need to correct them? Why? Well, we can't keep accounting errors. We can't keep errors, mistakes in our accounts. No. No. That will generate a wrong picture to our stakeholders. When we prepare our final accounts, the figures, the final outcomes will be misleading because they are wrong. You know that the process of accounting provides information to stakeholders of the business. Internal stakeholders as well as external stakeholders. Internal stakeholders like the top man, the boss, owner. It could be a director, it could be a chairman. Commonly, let's say owners. So owners are the most important, most probably the most interested internal party in any business. They are the most interested one. They are the ones who are worried. They are the ones who are concerned. They are the ones who are running around shouting at employees. Hey, Siripala! ඔය බඩු ටික පටවනවා. අද මේ order එක දෙන්න ඕන. Owner's boss is always concerned about the business. Yeah, he's concerned about the time. He's concerned about the deals and sales and everything. Yeah. Yeah. So owners as a stakeholder, they are one of the main stakeholders, internal stakeholders. Then we have managers. Then we have employees. So many parties inside the business, right? Internal stakeholders, owners on top, then managers, then employees. So many employees can be there. Hundreds and thousands of employees can be there. Not only to those stakeholders, we provide information to external stakeholders outside the business. Yeah, external stakeholders also take information from our accounts, our accounting records, our financial reports. External stakeholders like suppliers, competitors, customers, banks and other financial institutions. potential investors. You must be getting flashbacks about the second lesson now. Business environments. We talked about all these stakeholders. Yeah. So when we provide our accounts when we provide our reports, financial reports to stakeholders, we means who? I just said when we provide, right? Yeah, I said that. Just now I said when we provide our accounting records, our books of accounts, our reports. Who are we? We are accountants. That's right, we are accountants. Okay. When we do accounting, we are accountants. When you do an accounting question, you must think of yourself as an accountant. So when we provide our accounting records to our stakeholders, okay, external stakeholders and internal stakeholders, okay, if we provide wrong information, children, with errors, with mistakes, without correcting them, we are misleading these stakeholders. They might take wrong decisions depending on our accounting records, depending on our financial reports. Serious matters. Okay. That's why we must correct if there are any errors. Accounting is expected to provide accurate information to stakeholders. Didn't I tell you? I told you. Accurate information to stakeholders in making decisions. Yeah. However, errors may occur when business transactions are recorded. We are humans. Accountants are humans. We are not machines. We make mistakes. It's natural. No worries. It's natural, okay? Errors may occur when business transactions are recorded. Errors may occur. We record transactions in the books. We might do errors. Errors might happen. Okay. It's natural. So, when business transactions are recorded in prime entry books, when they are posted to the ledger, when transactions are posted to the ledger, balancing ledger accounts, and even when the trial balance is prepared, there can be errors. Okay. All right. Let's see now. Let's see. Errors may occur when business transactions are recorded in. I'm using different colors. When business transactions are recorded in prime entry books, ledgers, balancing the ledgers, as well as trial balance. Yeah. So, we are talking about 4 places here that places where errors could occur. Prime entry books, first place. Prime entry books. When transactions are posted to the ledger. Okay. When balancing the ledgers, and when balances are taken to the trial balance. Yeah, errors could occur. 4 places where errors could occur. 4 places. Alright. If such errors had occurred in accounting process, correct information cannot be provided to the stakeholders to make decisions. Therefore, such errors should be corrected. This thing I just now explained. Okay. Same thing. that we explained, that we discussed just now. So going forward, occasions when accounting errors may occur. Places where accounting errors could occur. Places where they could occur. Places where accounting errors may occur. Situations. Occasions. Places. Situations. Situations. Right? Where accounting errors may occur. The ones that we marked in the previous slide, we just marked the 4 places. Here, I have marked in red color. These are the 4 places. 1, 2, 3, 4. In prime books, when preparing prime entry books, when posting to the ledger accounts, when posting double entries to the ledger accounts, when balancing the ledger accounts, yeah, and when the balances are taken to the trial balance. These are the 4 places. Let's see. When transactions are recorded in the prime entry books, just like I told you, first one. Second, when transactions are posted to the ledger accounts from prime books, double entry. The second also the same. Third also the same. The places, the text which I marked in the previous slide. When balancing the ledger accounts, third also the same. Fourth, when preparing the trial balance, fourth also the same. Yeah. So these are the errors that can take place. Places where errors could occur in our accounting records, in our books of accounts. You know, when we take a book and open the book, we just don't see errors readily. We have to trace them. We take our ledger books, we take our ledgers, open the ledgers, we go through our ledger accounts, and errors are not highlighted in red color. They are just like any other entry in any book, in any ledger account. There are so many entries. You know, just take the cash book for an example. How many entries can be there in a cash book for a month? For a period of 1 month, how many entries can be there in a cash book? Debit side, hundreds. Credit side, hundreds of entries. So errors are not highlighted in red color in the books of accounts. We need to trace them. Trace. Check, one by one sometimes. Yeah. Currently, that is not the case in the present day, children. I have to give you the actual scenario too. In the present day, at the present moment, books of accounts, you know, manually recording, drawing ledger accounts and recording by hand is done very rarely, not very common, because computers are there. Now all the accounting processes are computerized. Computerized accounting packages are there. So errors can be traced easily. But we are not talking about computerized accounting systems. We are talking about manual recording. Books. Okay. Good old fashioned way. Good old fashioned way. Not the modern way. In these type of accounting records, children, when prime books are prepared, the bookkeepers can, you know, commit errors. The bookkeepers might have done errors. So when transactions are recorded in prime books, let's take an example. For an example, let's see, errors may occur when recording transactions in the prime books. Something like this. A sales invoice of 20,000, credit sales done to a customer, and the sales invoice is 20,000. It has not been recorded in the sales journal. Error or not? Of course, it's an error. It's an error. Yeah. A sales invoice of 20,000, credit sales, has not been recorded in the sales journal. It's an omission. Forget. We could, people could forget things. People try to forget things sometimes, yeah. We are not talking about those things. When I talk to girls and boys, sometimes they say, "Sir, I'm trying to forget that. I can't seem to forget that. That chapter of my life is over. I'm trying to forget that. It's over. It's over, sir." No. We are not talking about those type of forgetting. We are talking about forgetting transactions. Forgetting transactions, omitting transactions. A transaction has occurred, but it has not been entered in the relevant prime entry book. See, a credit sale of 20,000 has occurred. It has happened, but not recorded in the book. Error, right? Yeah. A purchase invoice of 50,000 has been entered erroneously as 5,000. That is an even serious one. That is even more serious. A purchase invoice, now this is 20,000 and it has not been recorded in the sales journal. This is 50,000, right? A purchase invoice. Purchase invoice, that means we have purchased goods. That is the source document. Why are you looking at me like you have never seen this word? This is the source document. Purchase invoice. This is the source document, children. This is the source document. Purchase invoice. Purchase invoice is issued for credit purchases. When we purchase more and more goods, but on credit without paying cash, we bring in goods to the business. So purchasing goods on credit, purchase invoice is issued. It's a 50,000 purchase invoice. What is the error? It has been entered erroneously. Erroneously means in error. It has been entered in error as 5,000 in the purchases journal. See, these are the errors. These are the errors which can occur in prime entry books. You can omit, you can misplace invoices. Sometimes the bill, the invoice must have gone with the wind. When you do transactions outside in the Sunday fair, in the marketplace, when your business is a trading business, when you are trading, if your business is a vegetable stall, if your business is a fruit stall, if your business is a distribution business, practical, day to day, the real life, pole business happens outside, not in a building. Yeah, distribution businesses, the vehicles go all over the country, here and there. bills can be misplaced very easily. The salesman, when he was doing the transaction, he has issued the source document, let's say the sales invoice, and signed it, and he has handed over the original to the customer, and the copy he has kept somewhere on a table or on a lorry, on the seat of the lorry or somewhere, and he has forgotten it. කොලේ හුලඟ ගිහිල්ලා the bill has blown, it has been blown. Things happen. So invoice is misplaced, so invoice is not recorded in the if the invoice is not there, how can the bookkeeper record the transaction, right? So the bills get misplaced, and sometimes the bills get wrong amounts recorded. The bill is recorded in the wrong amount. Then the wrong amount is recorded in the purchase journal or the prime bookkeeper. 50,000 වෙනුවට 5,000 දාලා. That is what has happened here. Yeah. So these are the errors which could occur in the prime entry books. Second, when transactions are posted to the ledgers. First one, transactions are recorded in the prime entry books. Second one, when transactions are posted to the ledger accounts. Yeah. When transactions are posted to the ledger. Yeah. Posted to the ledger from the prime entry books. Yeah. That is another place where errors could occur. Now, prime books was given first. Prime books was given first. When transactions are recorded in prime books, errors could occur. Then ledger accounts are given. When transactions are posted to the ledger. Yeah. I'm talking about the places, occasions where errors could occur. But examples are also given. But the next one, third place, when balancing of ledger accounts. Fourth place, when preparing the trial balance. I want to talk about these examples too, okay? But before that, I'm going to ask you a question. You. I'm going to ask you a question. You. Yes, you. Didn't we talk about this order of accounting records or recording transactions? Didn't we talk about this order? Didn't we? Which order? This order. First, prime entry books. First, prime entry books. Second, ledger accounts. Third, balancing of accounts. Fourth, preparing the trial balance. Didn't we talk about this order? Didn't I give you a flow chart? You, Puta, you tell me. Can you remember or can't you? If you can remember, that's very good. Bookkeeping. If you can remember, that's really, I'm really happy. Bookkeeping process. The process of bookkeeping. Process of bookkeeping. We talked about bookkeeping process. I gave you a flow chart. Huh? You want me to remind you how the process of bookkeeping occurs or how it is done? I think I better. If I remind you of the bookkeeping process, you can easily memorize these places where errors could occur. All right, a very quick reminder to the bookkeeping process. Let's make it quick. If you can remember, just try to go with me. We took 1, 2, 3, 4, and 5. Five, yeah. Yeah, likewise. We took 5 steps. 5 steps. From the first step to the second, from the second step to the third, from the third step to the fourth, from the fourth step to the fifth. We took 5 steps. What was the first step? Tell me. Oh, what was the first level? What is the first level? This is the bookkeeping process, okay? The process of, shall I move to this side? Now is it clear? Process of bookkeeping. Okay? Process of bookkeeping. What is the first level? What do we do in bookkeeping? For the very first time, we issue the source document. The bookkeepers or the business issues the source document. Source document. Now, what are the source documents that you can remember? Invoices. Yeah, purchase invoices, sales invoices. Receipts. Yeah, receipts, correct. What? Vouchers. Yeah, vouchers, correct. Petty cash vouchers. Yeah, correct. Journal vouchers. Yeah. Source documents, the bills. In short form, in common language, we call them bills. From the bills, transactions are taken. The information or the transactions of the bills are taken to recorded in prime entry books. Prime entry books. Prime entry books. And there's another simple word that we call them day books. Every day we keep them in our business counter or the table or the cashier's desk. Day books are kept. And source documents, all the source documents are recorded in the relevant prime book, okay. Then from the prime books, at the end of a period, from the prime books, the additions, the monthly totals are transferred to the ledgers. Then ledger accounts are prepared. That is the fourth step. Not fourth, that is the third step. Ledgers. We call them T accounts. That is the casual, commonly used word, the name, T accounts. T accounts. We call them T accounts, yeah? T accounts. T, okay? We call them T accounts. Then from the ledgers or from the T accounts, when the ledgers are balanced, when the T accounts are balanced, when the T accounts are balanced, when the ledgers are, balanced. I'm doing all sorts of gestures to make you remember. Okay, when the T accounts, ledger accounts are balanced, the balance brought forward, the BBF. Can you remember the BBF? BBF is taken, the balances are taken to the trial balance. This is the fourth step, trial balance. And this one we discussed how to do the trial, how to prepare the trial balance in the previous video. Okay, trial balance. The trial balance, if it balances, if the trial balance balances, okay, let's use something like this. Yeah, if the trial balance balances, children, if it balances, okay, if the trial balance balances only, if the trial balance balances, what is this? Balances. If the trial balance balances, no problem. If the trial balance do not balance, that is the problem. Okay, that is the problem. Even if the trial balance balances, there can be errors. If the balance, the trial balance is not balancing, if it is not balancing, obviously there are errors. Okay, so here we know that there are errors. We are certain because of errors. Because of errors. Right? This is the bookkeeping process. The process of bookkeeping, just like I have written here. See, the process of bookkeeping here. Process of bookkeeping. This process, with this, you must be thoroughly familiar. You must be very well, in your heads, you must be very well familiar with this. In your heads. Okay, serious matters. This will affect you even in your A levels. Accounting, bookkeeping process, and the clear knowledge, understanding of this process. Okay. Children, when this bookkeeping process is done in any business, okay, the last step is blank. We didn't do the last step. Yeah, what is the last step? What is the last step? The last step here, it's blank. Last step is financial statements. You haven't learned about financial statements yet. I mean, with me in the grade 10 syllabus, no, financial statements not done yet. But in the grade 11 syllabus, the last, not the last, the 4th and 5th lessons are financial statements. Okay, with our DP education grade 11 teacher, you must have done financial statements. Right, there's a good, very well experienced sir who is doing grade 11. With that teacher, you must have done financial statements. If you have watched his videos, financial statements means grade 11. This lesson come in grade 11. Okay, grade 11 textbook, grade 11 textbook, this lesson, financial statements. This is the last step of the bookkeeping process, but actually it is not a part of bookkeeping. Preparing financial statements is a part of accounting. Yeah, okay. Now you must be wondering, bookkeeping and accounting, I explained it in a previous video. Okay, bookkeeping is the initial stages, initial levels of the accounting process, and recording of transactions in the books of accounts. That is the bookkeeping process. See, books of accounts, prime entry books, ledger accounts, ledger books. These are the books of accounts. So recording transactions in the books of accounts is the bookkeeping process. It's the bookkeeping actually. And preparing the trial balance. When preparing the trial balance, we can get to know if the trial balance balances, even there are errors. But if the trial balance is not balancing, we can get to know that there are errors. When there are errors in the trial balance, when there are errors, the trial balance do not balance. No, it doesn't balance. Okay, it doesn't balance. But even if it balances, there can be errors. Which places, in which stages? There can be errors in here. There can be errors here. Can be errors. Okay, that is the first place where errors could occur. When transactions are recorded in prime entry books. See, we discussed. Second, when transactions are posted to the ledger. When transactions are posted to the ledger. So there can be errors here. There can be errors. Here in this place also there can be errors in ledgers. Then first is done. Okay, we are clear with that. Second place where errors can occur, that is also done. We are clear with that. Third place where errors could occur, when balancing of ledger accounts. When balancing of ledger accounts, that is here. When T accounts are balanced. BBF, balance brought forward, is taken. When the BBF is taken, when the T accounts are balanced, errors could occur. Fourth place is this one. When trial balance is prepared. Okay, right. When trial balance is prepared. When trial balance is prepared. That is the final, this part. This level, trial balance. When this is prepared, even when this is prepared, errors could occur. Okay. So this is the bookkeeping process, and places where errors could occur in the process of bookkeeping. That's it. It's so very clear now. If you want, you can take your screenshots, but you must have screenshots. You must be having screenshots already, because we discussed about this bookkeeping process earlier. In the trial balance lesson, in the previous lesson, I gave you this bookkeeping process. This is not in your textbook. Okay, don't go and search for this in your textbook. It's not there. It's a shortcut, a brief, short, easy method or process which I'm giving you in order to remember the steps of bookkeeping, the process of bookkeeping. Okay, recording transactions in the books of accounts. And accounting in the process of accounting, this is the very first stages. Okay, finally here financial statements are prepared. Financial statements are prepared by the accountants, and financial reports are produced by the accountant. Okay, profit and loss is calculated, and financial position is calculated, and the directors, the chairman, the owners can look at the financial statements and discuss with the accountant and take their decisions. Okay, that is the process. All right, so next, children, we have identification of accounting errors. We must identify accounting errors. Errors identification means you must be able to trace out errors and identify what type of an error has occurred, right? So we'll keep this and take it in our next chapter. For now, children, the introduction to the lesson is done, and places, occasions where errors could occur, we identified. Bookkeeping process, we reminded ourselves, and we'll take accounting errors one by one, and we'll identify them, and we'll blow them off. We'll correct them. We'll learn how to correct them. Right. So with that, children, I end this session. Thank you for being with me. In the next chapter, we are going to talk about errors and how to identify errors and how to correct errors. So be good. Do your work. See you soon.